You think breakouts fail because the market is unpredictable. I want to challenge that idea. Most traders do not lose money because they cannot spot a breakout. They lose money because they see movement and assume movement means opportunity. Price jumps above resistance, candles expand, volume rises, and they rush in. They believe the market has made a decision. But has it? That is the question most people never stop to ask. Because a breakout by itself proves almost nothing. Price can move for many reasons. Emotion can move it, news can move it, panic can move it, short covering can move it, excitement can move it. The market can sprint for a few minutes and then forget why it started running in the first place. What confirms the move is not the breakout. The pattern confirms the breakout. Now think about that for a moment. If a man suddenly starts running down the street, you notice movement. But movement alone tells you very little. Is he exercising? Is he late? Is he escaping danger? You need context before movement has meaning. The market behaves the same way. You see, traders become hypnotized by action. The eyes are naturally drawn towards speed and expansion. A stock breaks resistance and suddenly there is urgency. People feel they are missing something. Their thoughts become compressed. I need to enter now. What if it keeps going? What if this is the move? But the market has a habit of punishing emotional speed with financial speed. Have you noticed how many breakouts look powerful for 10 minutes and weak 1 hour later? Have you ever entered a trade because it looked strong, only to watch price drift back below the level you bought? You are not looking at a technical problem when that happens. You are looking at a psychological problem, because the crowd confuses activity with commitment, and commitment leaves footprints. Patterns are those footprints. Now let me explain what that means. A breakout is simply price moving beyond a known boundary. Resistance breaks, support fails, a range gives way. That is all. The market has crossed a line. But patterns tell you something deeper. Patterns tell you about behavior before the move happened. They tell you about pressure building beneath the surface. They tell you whether buyers are quietly accumulating, whether sellers are weakening, whether energy is being stored instead of wasted. Think about a tightly compressed range. Price moves up, price moves down. Days pass, weeks pass, yet the swings become smaller. Why does that happen? Because opposing forces are reaching a point where one side is slowly losing control. The important thing is not the shape itself. The important thing is what the shape represents. Most traders memorize patterns like vocabulary words. Triangle, flag, cup and handle channel, but names are not understanding. Suppose you see a flag pattern after a strong move upward. Price surges aggressively, then begins drifting lower in a controlled way. Now ask yourself a question. What would you expect if sellers were truly strong? You would expect aggressive selling, heavy pressure, large downward candles, but instead, price retreats slowly. Why? Because there is a difference between profit taking and genuine selling pressure. And that difference matters. Because creates effect. Weak selling after strong buying creates the possibility of continuation. That possibility becomes visible through pattern behavior. So when the breakout finally occurs, the breakout itself is not delivering the message. The pattern delivered the message earlier. The breakout simply confirmed it. Do you see the difference? One trader waits for excitement. The other trader studies behavior before excitement appears. And over time, that difference separates reaction from preparation. Now let us go further, because there is something else traders misunderstand. Not every clean-looking pattern deserves trust. This is where observation becomes valuable. Watch volume. Watch how price behaves near key levels. Watch whether the market repeatedly rejects lower prices. Watch whether pullbacks become shallow. Watch whether buyers step in earlier each time. Why does that matter? Because patterns are conversations, they are not pictures. Most people look at charts and see shapes. Experienced traders look at charts and see negotiations. Buyers pushing, sellers responding, pressure building, control shifting. The chart is simply recording human behavior, and human behavior repeats because fear and greed repeat. Now imagine a stock approaching resistance for the 4th time. The average trader sees danger. Resistance is strong, he says. But another question should enter your mind. If resistance is so strong, why does price keep returning? Think carefully. Strong resistance should create strong rejection. Repeated pressure against a level can mean sellers are slowly being exhausted. Every test consumes supply. Every return changes the balance. Then eventually price breaks, and people call it a surprise. But was it? Or were the clues already there? The market often whispers before it speaks loudly. The problem is that traders love noise. They want certainty to arrive with sirens and flashing lights. Markets rarely operate that way. Now let us make this practical. When you look at a potential breakout, stop asking only one question. Did price break? Ask a different question. What behavior led to the break? Where's price compressing? Was volume behaving constructively? Were pullbacks controlled? Did buyers defend key areas? Was momentum building gradually? Because if the pattern does not support the move, the breakout becomes vulnerable. A house without a foundation may stand for a moment. Then gravity takes over. Markets have their own gravity. Weak structure eventually reveals itself. And here is another thing worth remembering. A good pattern does not guarantee success. Nothing does. The market owes nobody certainty. But strong patterns shift probabilities, and trading is not about certainty. Never was. It is about placing yourself beside favorable conditions again and again and again. That is a very different mindset. Have you noticed how newer traders search for the perfect setup? They believe somewhere out there exists a magical signal that never fails. But professionals think differently. They think in terms of alignment. Pattern aligns with behavior. Behavior aligns with pressure. Pressure aligns with breakout. When several things begin pointing in the same direction, conviction becomes more reasonable. Not because certainty exists, because evidence exists. And over time you start seeing something interesting. You stop chasing every breakout. You become patient. You become selective. You begin watching quietly while others become emotional. And then you notice moments where price is moving, the crowd is becoming excited, volume starts expanding, resistance is near, and yet something feels incomplete. You cannot explain it immediately, not at first. But experience starts whispering something into your ear. The pattern isn't supporting the story. Most traders believe the breakout is the message. They see price pushing above resistance or falling below support, and they assume the market has finally revealed its hand. The movement looks decisive. It creates urgency. It creates emotion. And emotion has a way of making speed feel like certainty. But here is something worth thinking about. Does movement alone tell you why the market moved? Imagine seeing a crowd suddenly running in one direction. You immediately notice the movement. But movement itself explains very little. Something caused it. Something happened before that moment. Without understanding the cause, you are only reacting to what your eyes see. The market behaves the same way. Breakouts announce movement, but patterns reveal intention. That distinction matters because price can break a level for many reasons. Short covering can push price higher. News can create temporary excitement. Fear of missing out can pull traders into the market all at once. Sometimes a breakout is driven more by emotion than conviction. The problem is that emotion creates movement very quickly, but quick movement is not always sustainable. If there is no real pressure building underneath, price can reverse just as fast as it moved. So where do you find the real story? You find it before the breakout happens. Patterns are not important because of their shape. They matter because of what they represent. A pattern is simply behavior repeated over time. It shows how buyers and sellers interact before price escapes a level. Think about a market moving in a tight range. The swings become smaller. Price stops making aggressive moves lower. Buyers continue stepping in. Selling pressure slowly loses force. Now ask yourself something. Why would price continue returning near resistance if sellers still had complete control? That repeated pressure often tells a deeper story. Buyers are becoming more willing. Sellers are becoming less effective. Energy is gathering beneath the surface. The pattern begins speaking long before price finally breaks. Then the breakout comes, and suddenly everyone notices it. But the traders who understand behavior are not surprised. They have already been watching the clues develop. They have already seen the pressure building. This changes the way you look at charts. Instead of asking, did price break the level? You begin asking a different question. What happened before the break? Was volume gradually increasing? Were pullbacks becoming smaller? Did buyers defend important areas? Did price spend time building pressure instead of moving randomly? Because intention leaves traces. The market rarely wakes up one morning and decides to create a powerful move out of nowhere. Strong moves often begin quietly. They begin with behavior changing beneath the surface, while most people are still looking for excitement. The breakout simply makes the move visible. The pattern tells you why it became possible. Most traders train their eyes to watch price. They wait for candles to expand, levels to break, and momentum to appear. Their attention is fixed on the obvious part of the chart because movement feels important. Fast movement feels even more important. But let me ask you something. When a tree begins leaning, did the process start at the moment you noticed it? Or did something happen beneath the ground long before it became visible? Markets work in a similar way. Price moves first, but behavior speaks earlier. The difficulty is that behavior does not announce itself loudly. It does not create excitement. It does not attract attention. It develops quietly, often while traders are busy waiting for some dramatic signal to appear. Price is what you see. Behavior is what creates what you see. Most people only react to the final result. They see a stock suddenly move higher and think the opportunity has arrived. But the move itself is often the last stage of a process that began much earlier. Think about accumulation. Price may spend days moving within a narrow range. It does not look exciting. Nothing appears dramatic. There are no large candles attracting attention. To many traders, it looks like dead market action. But is it really dead? Look closer. Price pulls back and buyers appear. Price drops again and sellers fail to push it lower. Resistance gets tested repeatedly. Pullbacks become smaller. Volume begins appearing in certain areas. These small details matter because markets are built from human decisions, and decisions create behavior. Behavior reveals changing conditions before price fully reacts. A trader who understands this starts looking beneath movement instead of chasing movement itself. Because when behavior changes, price eventually follows. Cause creates effect. Pressure creates movement. Commitment creates trends. The market does not simply wake up and produce a breakout. Buyers and sellers gradually shift the balance until one side finally loses control. Now think about how most traders enter trades. They see strength and immediately assume strength will continue. But strong movement by itself can be misleading. Sometimes price rises sharply because traders are rushing into the market emotionally. Sometimes fear of missing out pushes price temporarily higher. The movement appears powerful. The behavior underneath may not support it. That is why experienced traders watch details that others ignore. How does price react during pullbacks? Do buyers return quickly? Are lower prices being rejected? Is volume supporting the move or disappearing? These things seem small when viewed individually. Together they tell a story. And stories matter because markets rarely reveal intentions through a single candle. A stock that quietly holds strength during weakness often tells you something before price ever makes a large move. A market repeatedly refusing to break lower says something before it starts rising. The signs are often there. Most people simply arrive late because they only trust what becomes obvious. Price eventually gets everyone's attention. Behavior starts speaking while nobody is listening. Most traders become interested when the market starts moving fast. Large candles appear, momentum increases, and suddenly attention follows price. People begin talking about opportunity because action creates excitement. But something interesting happens in markets. Many of the strongest moves do not begin with noise. They begin with quietness. Compression often precedes expansion. At first glance, compression can look unimportant. Price starts trading within a tighter area. The swings become smaller. Volatility decreases. The chart almost looks inactive. Many traders lose interest because they believe nothing is happening. But let me ask you something. Does silence always mean the absence of activity? Think about a spring being pressed down. As pressure builds, movement becomes smaller, not larger. Energy is not disappearing. Energy is being stored. Markets often behave in a similar way. When price starts compressing, buyers and sellers are still active. Decisions are still being made. Orders are still entering the market. But instead of producing large moves, those forces begin pushing against each other in a tighter space. Now ask another question. Why would price continue narrowing instead of collapsing? Because one side may be losing strength gradually without immediately losing control. This is where many traders misunderstand what they are seeing. They focus on the reduced movement and assume reduced movement means reduced opportunity. But reduced movement can sometimes signal the opposite. It can signal preparation. Look at how price behaves during compression. If pullbacks become smaller, if buyers continue defending levels, if selling pressure loses force, something may be changing beneath the surface. The market rarely announces these changes loudly. It leaves clues. Imagine a stock moving higher and then entering a tight range. Price pulls back slightly, recovers, pulls back again and recovers once more. Each decline becomes less aggressive. What does that tell you? If sellers had complete control, you would expect stronger downward movement. You would expect fear to increase. You would expect weakness to expand. Instead, weakness becomes limited. Pressure starts building, and pressure has consequences. Because markets cannot remain compressed forever. Eventually the balance shifts enough for one side to gain control. When that happens, the stored energy begins releasing itself. Expansion follows. This is why sudden powerful moves sometimes seem surprising to people watching from the outside. They only notice the expansion. They missed the compression that came before it. Experienced traders often pay more attention during quiet periods than during explosive ones. They understand that the market is frequently preparing before it is performing. The breakout itself may happen in minutes. The conditions that created it may have developed over days or weeks. This changes the way you watch charts. Instead of becoming impatient when movement slows down, you begin observing more carefully. Are highs tightening? Are lows being defended? Is volatility shrinking while support remains intact? Because compression is not simply smaller price action. It is behavior under pressure. Many traders believe strong moves begin with strong action. They expect large candles, heavy volume, and obvious excitement. In their minds, a powerful breakout should look powerful from the beginning. But markets often work differently. Strong breakouts usually begin with quiet accumulation. That idea sounds strange at first because people naturally associate strength with visibility. We assume that if buyers are interested, they should appear aggressively. We expect the chart to announce that something important is happening. Yet the market rarely rewards what is obvious too early. Let me ask you something. If large institutions or experienced market participants want significant positions, do you think they want attention immediately? Usually not. Large buying cannot always happen in a single moment. Large orders can move price too quickly and create unwanted attention. So accumulation often happens gradually. Buying appears in pieces. Activity blends into normal market movement. To an untrained eye, nothing seems special. Price may move sideways for days or even weeks. Candles remain relatively calm. There is no dramatic expansion. Traders searching for excitement become bored and look elsewhere. But beneath the surface, behavior can begin changing. Look carefully. Price dips lower and buyers appear. Selling pressure arrives but struggles to create follow-through. Pullbacks stop becoming aggressive. Price repeatedly recovers after weakness. Now ask yourself another question. If sellers are truly in control, why do lower prices keep getting rejected? That is where observation becomes important. Accumulation is not always about seeing aggressive buying. Often it is about seeing the market refuse to become weak. There is a difference. Many traders only look for signs of strength. Experienced traders also look for signs of weakness failing. Because when weakness repeatedly fails, it tells you something about demand. Think about a ball being pushed underwater. Pressure builds while the movement remains controlled. For a while, nothing dramatic happens. Then eventually the force keeping it down becomes weaker than the pressure beneath it. The release looks sudden, but the process started much earlier. Markets often behave in the same way. A strong breakout may appear explosive in the moment, but the conditions creating it were usually developing quietly beforehand. Buyers were positioning. Supply was being absorbed. Pressure was increasing. Then eventually price reaches a point where resistance can no longer contain the demand. People watching only the breakout think opportunity has suddenly arrived, but traders studying behavior understand that the market has been leaving signals for some time. This changes your focus completely. Instead of chasing movement, you begin paying attention to stability. You watch how price reacts during declines. You observe whether buyers continue stepping in. You notice if resistance keeps getting tested without creating major rejection. Because accumulation often hides behind ordinary price action, the market does not always reveal strength by moving higher immediately. Most traders look at patterns as shapes on a screen. They memorize names and try to match what they see with what they learned. Triangle, flag, channel, range. They search for familiar pictures because pictures feel easy to recognize. But here is something important to understand. Patterns expose the balance between buyers and sellers. The shape itself is not the story. The behavior creating the shape is the story. Let me ask you something. If two people are pushing against each other with equal force, what happens? Very little movement. Neither side gains control because the pressure remains balanced. Markets operate in a similar way. Every candle, every pullback, every rejection is simply the result of buyers and sellers competing for control. Patterns are the footprints left behind by that struggle. This is why two charts can appear similar while meaning completely different things. A triangle pattern, for example, is not important because lines can be drawn around price. It matters because it can reveal changing pressure between opposing forces. Imagine price repeatedly moving into resistance. Sellers push it back each time. But with every pullback, buyers return sooner than before. Lows begin rising. Weakness becomes smaller. Now ask yourself something. If sellers still controlled the market completely, should buyers be able to push price back so quickly? Probably not. The behavior itself starts revealing a shift. Sellers may still be resisting higher prices, but their influence is no longer creating strong downward movement. Buyers keep returning. Pressure slowly begins building. The pattern records that process. Think about what this means. A pattern is not predicting the future. It is showing you what is happening right now beneath the surface. This is where many traders make mistakes. They become focused on whether a pattern works, instead of understanding what the pattern represents. No shape carries magical power. The market does not move because a triangle appeared on a chart. The market moves because buying pressure and selling pressure are changing. The pattern simply allows you to observe those changes, because creates effect. If buyers become stronger while sellers become weaker, the balance shifts. If sellers absorb every attempt to move higher, the balance shifts another way. The important thing is not memorizing formations. The important thing is learning to read behavior. Look at pullbacks. Are they becoming weaker? Look at support levels. Are they holding consistently? Look at resistance. Is price repeatedly returning without major rejection? Because patterns are conversations. Every movement says something. Every reaction reveals something. The market is constantly communicating through behavior, but many traders only hear the loudest part of the message. Experienced traders often pay attention to what the market struggles to do. If price struggles to move lower despite selling pressure, that matters. If price struggles to move higher despite buying pressure, that matters. Patterns help reveal these hidden details because they expose something deeper than movement itself. Most traders see resistance as a wall. The market reaches a certain level, price gets rejected, and they immediately assume that level has become stronger. Then price returns again, gets rejected once more, and their belief grows even stronger. 3 rejections, 4 rejections, 5 rejections. To many traders, repeated tests mean danger. But let me ask you something. If a locked door is being pushed repeatedly, does the pressure against it make the door stronger, or does it slowly test the strength of the lock? Repeated tests can weaken resistance, not strengthen it. This idea often feels backward because people naturally focus on what they see immediately. They see price failing at a level and think sellers are winning. But markets often reveal more through repetition than through a single reaction. A resistance level exists because sellers are willing to defend that area. Supply enters the market and prevents price from moving higher. That part is simple. The important question is this: What happens each time price comes back? Because every test creates a new interaction between buyers and sellers. Imagine price reaches resistance and gets rejected sharply. Sellers push aggressively and price falls quickly. Now that tells a certain story. It tells you sellers are active and still capable of controlling the area. But suppose something changes. Price returns again and the decline becomes smaller. Then price comes back another time and sellers create even less downward movement. Then buyers return more quickly after each pullback. Now ask yourself another question. If resistance remains extremely strong, why are the reactions becoming weaker? That is where behavior begins speaking. Markets are driven by supply and demand. Sellers defending a level do not possess unlimited power. Every time supply enters the market, buyers absorb part of it. Think of resistance like inventory sitting on a shelf. The first wave of buyers meets a large amount of selling pressure. Price reacts lower. Then buyers return. More supply gets absorbed. Then they return again. Even more supply disappears. Over time, if buying pressure continues while selling pressure becomes less effective, the balance starts shifting beneath the surface. Price may still be below resistance, but conditions are no longer the same. Most traders only see the level. Experienced traders watch the reaction around the level, because the reaction often reveals whether sellers are becoming stronger or becoming exhausted. Look carefully at what happens during repeated tests. Do pullbacks become smaller? Does price spend more time near resistance? Do buyers step in earlier? Is volume supporting the pressure? Because repeated testing without strong rejection can mean demand is gradually taking control. Pressure builds, energy builds, and eventually a point can arrive where resistance no longer acts like a wall. It becomes a door that has already been weakened before anyone notices. Then the breakout happens. People watching only the breakout think something sudden occurred. But traders observing behavior understand that the market had been leaving clues for some time. A breakout can look convincing. Price pushes above resistance, candles expand, volume rises, and suddenly the market appears full of energy. Traders see movement and immediately feel pressure to act. The fear of missing a move begins speaking louder than logic. But appearance and reality are not always the same thing. A breakout without structure often lacks commitment. That matters because markets can move quickly without moving meaningfully. Let me ask you something. If you build a house on weak ground, does the house become stronger simply because it looks impressive from the outside? Probably not. The foundation determines whether the structure can support what sits above it. Markets operate in a similar way. A breakout is visible movement. Structure is what supports that movement. Without structure beneath it, price can rise sharply for a short time and then collapse just as quickly. This is where many traders become trapped. They see the final burst of movement, but ignore everything that happened before it. Their attention goes to the breakout itself, because the breakout creates urgency. Strong candles create excitement. Fast movement creates emotion. Emotion creates decisions. But strong decisions should not be built on excitement alone. The important question is not simply, did price break? The better question is, what built the conditions for the break? Did price spend time consolidating? Did buyers continue defending key levels? Were pullbacks becoming controlled and smaller? Was pressure gradually increasing beneath the surface? Because structure is really the market showing consistency before expansion appears. Think about a market that suddenly explodes upward after moving randomly for several days. Price had no clear behavior. Support was inconsistent. Pullbacks were aggressive. Buyers showed little control. Then suddenly one large candle appears and breaks resistance. Now ask yourself something. Did behavior actually change before the breakout happened? Or did movement simply become larger? There is a difference. Large movement can attract attention. Structure builds confidence. Without structure, the breakout may simply be driven by temporary emotion. News can create it. Short covering can create it. Fear of missing out can create it. These things create movement. But movement alone does not always create sustainability. Strong breakouts usually have evidence beneath the surface. They often show signs of preparation before signs of expansion. Price may tighten. Resistance may get tested repeatedly. Selling pressure may weaken. Buyers may return faster after every decline. Small details begin aligning.